Welcome to Your Financial Journey, where we discuss everything financial, leading you to your future destination. Today, we're going to cover the economic perspective again, SMART goals, COVID-19 and some of the updates for potential impact, the 4 phases that people are going through to help make the most of what they're doing, and how to understand that in relation to what we find in the economy and with government and business. Market recovery types, we're going to update some information on that as well. Fundamental and technical considerations for the markets and the economy. What to look for in the coming weeks, and your risk-reward discussion, and then your questions at the end. As I've shared with you every week, and probably will continue to share with you, economic uncertainty is certain. And the sooner we can recognize that, the easier it is for us to recognize that what's going on right now isn't the end of the world, it's just a process, and we'll talk more about that as well. Economic prosperity is only identifiable in retrospect. I wish that weren't true, but it is. It doesn't mean we can't take a look at facts and information to make better decisions going forward, though, to identify opportunities that are possible and available to you. Economic cycles are typical. If you spend any time with me, you know that we talk about that a lot, the cyclical nature of the economy and the markets, investments, everything. Future cannot be predicted. I shouldn't have to say that, but I do think that sometimes people think that is not true. And sometimes I think they think I can, and I cannot predict the future. I get questions every once in a while. I'm like, I don't have any idea. Like you, we're trying to figure out the best solutions and looking for options, which we'll talk more about that tonight as well. The last one, though, you'll notice I underlined it, is having investments is not a goal. Investments are a tool used to accomplish your goals. And I really think that that is so critical. The more I talk with people, and I had the same experience back in 2008 when the markets tanked, and in 2001 when the markets tanked, those who are focusing on their goals, whether they are goals for this year, for next year, for the next 5 years, for the next 10 years, they come through processes like this way better than ones who are just busy focused on all of the noise and drama that's going on at any point in time. And there is a huge amount of drama and noise happening. And with that in mind, if I can get clients to focus on what they're wanting to accomplish by the end of this year, or the end of next year, or the next 3 or 5 years, it seems that everything works way better then. And so again, I'm going to remind you of SMART goals. Those are goals that are set with a specific target for improvement. They are measurable. They quantify at least, or at least suggest an indicator of progress. They're assignable, meaning we can assign them to people, which fits very well into our return on life discussion. They are realistic. At least they are realistic with what your optimism and hope is. And they state which results can realistically be achieved given the available resources, which again fits back into our whole planning process. And then finally, time related. I think that, again, if we're only focused on what's happening today in the markets or what's happening tomorrow in the markets, we're missing huge opportunities to take advantage of new opportunities and real chance to make things work really well. Because while there's going to be bad stuff, there's also going to be good stuff, which we're going to talk about that today also. So just some of the updates from what we've seen this last week since we had our last update. The U.S. has had more than 787,000 confirmed cases of COVID-19 with 42,000 deaths so far. News around the world about COVID-19 appears to be improving. 22+ million people have been furloughed as of the last numbers, laid off or terminated in the last 4 weeks, and that places unemployment somewhere around 10 to 15%, but probably it's going to go north of 20%. I don't know if you followed yesterday, but the May oil contracts traded negatively because of oversupply and low demand. And if you watched it at all, I know we did, with disbelief, but really not, because if you begin to understand delivery versus a contract for delivery, you begin to realize why this could happen. But we saw oil go from down to 25, down to 11, down to 7, then down to 10 cents, then down to 3 cents, and then it went negative. And one of the reasons I took time to point this out today is because it is an example of an unintended consequence that 2 weeks ago or 3 weeks ago, very few people would have thought that a barrel of oil would actually go negative, meaning that you're going to have to pay them for them to buy it from you. You're going to, reverse of that. You're going to pay them to take it because they don't want it. Now, if you spend any energy on that, what you found out was this was dealing with just the May contracts. The June contracts for oil are not negative. Will they go down? They could. Will they go down in value? It's possible, because what everybody's trying to figure out right now is what is supply and demand. So, for instance, if we have a lot of oil, but we don't have much demand, it makes it harder to know how to sell it. And so it's going to drive the price down because there's way more resource than what we need. But that will change. And the truth is, when we look at the unintended consequence, and this is one that you can sort of put on the back burner and just watch this over the next 12 months, 18 months, 24 months. So what's happening right now is the whole oil industry is being crushed. I'm not trying to be dramatic. It's just that there were a lot of people who were doing a lot of work, and they're not now. Part of the reason they're not is because in order for oil to be a profitable tool, it has to be selling somewhere between $30 and $35 a barrel, and I kind of believe it's about $35 a barrel is minimum. Most of the people we work with who deal with that tell us that 35 is how they build their model, that being the worst case scenario, but they do calculate for $30 a barrel just in case things were to happen. Well, here we are, those things have happened. So what will happen? Well, some of those people will be laid off and not brought back. Some of those businesses that process or distribute or drill for oil, they'll go out of business. And so they will not have those jobs for a while. But then all the oil we have means that you'll be able to buy it and keep it going, and that'll be fine. But at some point, the demand will outpace the supply. And so then people will have to come back to work again. They'll start opening businesses again, and that will make it so that people will be able to start making a living again. But unfortunately, what will likely happen, and this is what you can sort of take to the bank, is that it's not at all unreasonable to think that oil wouldn't hit $100 a barrel again, like it did in the last 2 decades. And so when that happens, it'll be more expensive at the gas pump. And you say, why would that have to happen? Well, because things don't happen overnight. It won't be so simple that all of a sudden we're just drilling again and there's oil coming out of the ground and we're shipping it from place to place and running it with tankers and trucks and so on. It just won't happen. So there will be an ebb and a flow with the oil. And so these contracts that went negative in value really didn't go negative in value. I mean, they did. Nobody could buy them. Nobody would buy them because they knew they couldn't deliver on that oil in the next day and make any money on it. But we may see more of that. We might see that in June. We might even see it in July. But it will be one of the unintended consequences as we work back through this. And the reality is, from looking at 2008 and 2001, there'll be more of those. But that's why I encourage you to maintain SMART goals. Having investments isn't for the sake of having investments. Having investments is to achieve goals. And as you begin to think about things like oil, or even right now, we were talking about meatpacking plants in the Midwest that are closing down because people are getting sick. Well, what happens with the hamburgers and the steaks or chicken or pork? What happens when it comes time for those restaurants to open up and there's less supply and the demand is starting to outpace that? One of the TV financial talking heads we listened to was joking about how much will his Wally wings cost. The reality is we don't know. That's part of what this whole process is. And so that unintended consequence that showed itself yesterday is just one of many things that will happen over the next 2, maybe 3 quarters. So don't let it throw you off. It's just part of the deal. But as we work through it, and I'm going to show you how we work through it today to kind of help with that, it will bring about some confidence that you can set your goals and go forward into the future with some understanding of what you're facing and what you can do with that. Another thing that is starting to catch people's attention is concern, weakness, and debt. Personal debt, business debt, state and local government debt, and while we're not talking about it yet, federal debt. We just passed another multi-billion-dollar stimulus package. Talk about that in a minute as well. But how do we pay all that back? I mean, the government doesn't make anything. It doesn't produce anything. It doesn't build anything. I mean, it hires people and transfers money from one group of people to another group of people, whether it's through government contracts or whether it's through welfare programs or whether it's through school programs, whatever it is. It doesn't produce anything, though. It counts on us to produce something. So what happens when state and local governments, counties and states, aren't having any revenue come in because they're shut down? We haven't even begun to talk about the bailouts that those groups will have to have. In 2017, Illinois had their debt quality reduced to just above junk bonds. And what happens when Illinois, for instance, stumbles? I mean, they may not, but they just as easily could. So what happens then? What happens with personal debt for all the people that don't have much in savings and haven't planned ahead? What happens with all that? So all of that is out there. Now, again, I know it's easy to immediately go to a fear model on this. I'm not afraid. I'm just recognizing those are things we have to be thinking about so that we go forward, we make good decisions when it comes to how we invest, how we protect money, how we make decisions. And as always, I try to tell you everything I'm thinking about so you can make good decisions as well. So those are some of the areas that are sort of unintended consequences of COVID. Oil going negative for a period of time in a day trading session, meat from packing plants not being able to deliver like they could once the supply and demand starts to pick back up again, debts with individuals and state and local governments and business and the federal government. All these issues will be things we have to think about. But we worked through them in 2008, we worked through them in 2001, and we will this time as well. We just have to be thinking ahead about what we're going to do with that. Next, the federal and state governments are implementing strategies for restarting the U.S. economy state by state. There's plans in place now. We're starting to see what those plans look like. It's unsure how the virus is going to respond when we begin to reconnect socially. And so that's one of the things we'll be watching too, because if we don't do it well and it puts us in another stay-at-home model, that would be even more dreadful. So we want to take a look at that as well. Money from the CARES Act is starting to be distributed. We see some of the PPP loans going out. We see some of the checks being received for the income rebate for those with receiving money for spouses and so on. We see unemployment numbers. We see those increase in checks going out, but it's slow. And as I expected several weeks ago when we started these updates, I told you it will take it a while. Government's not designed to hand out money. I was talking with somebody just last night about how the way the government's doing this is through the U.S. Department of Treasury. It's one of the few federal models that knows how to hand out money. They do it in tax refunds every year. Beyond that, they don't know how to hand out money. So it's going to be a process. They hand it through the states, and the states then have to do it. And unless you're on unemployment or welfare, they don't know how to do it either. So it's going to be a process, but it is starting to happen, and that's a good thing. Treasury Secretary Mnuchin has 100+ business leaders advising the administration on how to reopen the U.S. When it comes to coronavirus, it's not going to be a one-size-fits-all. For instance, Arkansas, Hawaii, Maine, Montana, North Dakota, Vermont, West Virginia, and Wyoming. I hope I got all the states right. They're below 1,000 coronavirus cases versus other states which are way above that. So how they're going to handle their rollout versus how other states will be two different things. As a matter of fact, Georgia, South Carolina, Tennessee, and Texas are going to begin opening businesses in the coming weeks. They're going to be one of the first places to start this. So we get to watch how that works and see how all of this discussion that we've been having for the last few weeks will show itself, what the results from that will be. The Federal Reserve and U.S. Department of Treasury are continuing to aggressively create liquidity in the banking system to protect credit availability as well as keep the velocity of money moving. In regards to that, the PPP program handed out $350 billion, 1.6 million in loans requested. That money lasted for 13 days. The new one that's coming out, about $250 billion, it's estimated might only last for 2 days. We don't know how this is all going to work. But again, the government's not designed to be the one who keeps our economy moving. It's just designed to kind of keep greasing the skid so it can move forward. And that's what we're hoping will happen as we reopen the country. As I've shared with you before, I believe this is still true. These actions will not curb the immediate impact on business, but we will find that it will help it. But we're still going to struggle for the next 3 or 4 quarters as we try to figure out what normal looks like again and then how we go forward with that and how we get back to normal, to be honest with you. The U.S. will likely go into recession the second quarter. I almost put down today that it will, but we'll wait and see. But it seems pretty realistic that we will, and it probably will be the third quarter as well, and it might even flow into the fourth quarter. But we'll watch, and as we get more information, we'll make those decisions and share that with you. Because whatever we think we know today quickly becomes outdated. And that is more true now than I've seen before. So the 4 phases get back to normal. I've shared this with you before, but this week I added up something new. One, I moved the arrow up a little bit further because I think we are here is a little farther along than it was last week. And if you have not been to whitehouse.gov Opening America, you can read more detail on what they think of as the phase 1, phase 2, and phase 3 for individuals, employers. And this is guidance they're giving to the governors of the various states so that they can make decisions on how to open their states. As I just mentioned a moment ago, some states like Georgia and Tennessee, Texas, they're ready to get going. Other states aren't ready to get going yet, and so they will have to work on that. And what we might even find is in a state like New York, it might be that certain counties open up and other counties don't open up yet. Because as we break this down to what's going on even within counties or townships, we might find that some places are ready, other places aren't. That's why I shared with you all those states that had less than 1,000 cases right now. As soon as we move from the government telling us we can to the idea that we feel safe that we can, I was just talking with Paul earlier. We were talking about maybe only 1/3 of the people, once they're told they can go out, will do it. Just those who are just, they're early adopters, they're rebellious, they're fast, they want to get on the track. They'll do it. There'll be 1/3 who won't for quite a while, and there'll be another 1/3 who'll be testing the waters. So it will take a while for us to move from phase 1 to phase 2, but as we do, businesses will start to do better, and then we can start to see some things, but there will be messy challenges there, like I just mentioned before about food supply. Those will be issues. But eventually, hopefully within the next 12 to 18 months, we will be back to normal capacity again. And the market won't wait for 12 to 18 months to make that happen. It will begin looking way back in here when to make decisions. That's why I'm thinking that probably sometime in June or July, we're going to see some new information when it comes to the fundamental and technical analysis. The fundamental analysis may not support it, but the technical will, but we'll see. For those of you who watched, we've normally put the W and the L on there, but I decided to take them off because I think that this is getting more obvious. It's not guaranteed by any means, but I think it's getting more obvious. It's either going to be a V or it's going to be a U. Again, anecdotally, I've talked with several of you, a number of you, and it's funny. We talk about how places like Lowe's or Home Depot are just full right now. Talking with Paul earlier about some Whole Foods kind of store that was open that sells mostly vegetables. They were packed. So people are wanting to get out. So when you hear that kind of thing, you think, wow, maybe we will have a V recovery. I don't know, but we're watching. So far, I'm still kind of holding to the U, but if it's a V, I'll be very happy. I've shared with you the 4 primary engines that run our economy: interest rates, unemployment rates, business profitability, and GDP growth. As many of you have said to me, it becomes really obvious that business profitability is going to be a problem. Unemployment rates are obviously going to be a problem, so therefore GDP growth is going to be a problem. But if they can continue to hold interest rates down, which everything so far, even in the last week, we keep seeing them drop, that's a good thing because that'll keep at least one engine functioning until the others can fire up again. I shared with you before that pre-COVID, we were pluses on all of them. Next couple of quarters, we're probably going to be negatives on several of them, but I think that will change as well. So what I want to do is talk about something called market rotation, which deals with the various industries inside the S&P 500. Now, you may recognize that the S&P 500 is 500 biggest companies by various industries. And so when we break out those industries, it's not that everything is tanking. The reality is some things are actually doing well. For instance, communication services are doing well. That kind of makes sense. Technology is doing well. That definitely makes sense. Staples, things like toilet paper and water, milk, and so on, those are doing pretty well. Healthcare, that makes sense. That's doing well. And so are utilities, because we're home more, using more electricity and water and gas for the stoves and so on. So those are areas that are improving. Now, what may not be so obvious is that there is a rotation to the process. Now, I've shared it. I didn't pull the slide up because I've shown it so many times. But the cyclical nature, the peak and the trough, the early downturn, the downturn, the trough. Then we got the early upturn, the upswing, and then we've got the peak again. Well, that actually comes from this concept, which is a market rotation. That's a pretty complex chart. I'm sorry about that. But it is something that kind of gives us some insight into what we're looking for. So first of all, up here at the top, we can see that I put checks by the areas I just mentioned before that are doing well. And when you look at the rotational sector of that, you look here, full recession, early recovery, full recovery, early recession, which honestly, we have really just blown right through early recession. But what we do see, and we see these various industries here, these go down as you move into recession. This would be like a big circle coming back around again. So we can see that we're not quite in recession yet, although truthfully we are. We just can't prove it, but it's obviously going to show itself here pretty soon. And what you see is these are sort of lined up as to what does well as you work through the recovery process. So you're at the market bottom, which we may or may not be. I guess it really honestly is going to be dictated by where we are in this process right now. But as we move through the process, we hit the trough again, we begin to move up. We move from bull market, early recovery. And so then industrials and materials start to take over. Energy, we need more of that, and that's what's being hammered right now, as I just shared about oil, supply and demand. So some energy, like electricity for your house, which requires power plants, and maybe that's coal, maybe that's oil, maybe that's nuclear, those things will begin to take off more as we begin traveling, because staying at home just isn't generating, whether it's because of trains or because of supply chain issues, whether it's cars driving around, whether it's flying from place to place, those things just aren't generating the resource right now. But as we move into recovery and the bull market, then we start to see that growth period. And again, it doesn't happen in one day. I think that's another thing, is that everybody sort of has this idea that it's like a microwave. In fact, we even talk about it, turning the economy on. You can't just turn it on. It's not like a switch. It's not like go hit the button and 60 seconds later we got a dinner. The reality is that we have to have a process that builds from where we are to where we're going. And I used the example last couple of weeks about those light bulbs you get that go 50, 100, 150. That's what we're doing. That's what this is describing, a rotation. So as you go through the stages, full recession, early recovery, early recession again, then you move over here, come down here. So full recession, you look at reviving. You start to move through that because consumers begin to think we're going to start to revive, but they're just worried about it. I mean, you and I want to see the economy revive. We're hoping for it. Then we start to see it to rising. But the truth is, we're back over here still, more likely in this area, saying, oh, it feels like it's going to decline. It's going to be terrible. It's going to fall sharply. As you can see, this rotation is what we're looking for. And as we look at the rotation, we flip back up here to the top because we begin looking at the industries inside of the S&P 500 or the Nasdaq or the Dow, the Russell 2000. We look for those to say which areas are going to do better, because we can begin to see which areas are going to work through that rotational shift of recession to out of recession to back in recession and so on, the cyclical nature again. So I wasn't really comfortable to adjust this chart. I still feel like we're somewhere in early downturn to full downturn, but I don't know yet. But just looking at data, I still think we're probably still up in here, which I wish we were down here. I wish that would make it faster. But the fact is, we're going to have to wait for more information. We're going to have to see earnings reports from companies. We're going to have to watch how supply and demand works. We're going to have to watch what happens as we start to not social distance anymore. We'll have to see how that all fits. Because the truth is, nothing is going to get better until we feel safe. I said it last week. When the banking challenge happened back in 2008, until we felt comfortable the banking system was going to survive. That was what bailing out the big banks, whether you liked it or didn't like it, whether you thought it was the right choice or not, we had to feel safe that our bank was going to be here before we could start doing things. That was necessary when we had a good banking system to make an economy function. And back in 2001, we had to feel comfortable that terrorists weren't going to just kill us indiscriminately. And once we felt safe with that, we could start functioning. And this is exactly the same. As soon as we feel comfortable, and we don't have to have a vaccine. We do need one, but we don't have to have a vaccine to start feeling comfortable. As we start going out and living life again, as we start to feel comfortable, we can do that, and businesses can start to do business again, and people can start to be hired again, and all these processes can begin working again, then we will see this change. And so I think until we see more of that, we can't decide whether we are here. And I tell you this one other thing, which you may have already figured out, but this is going to have to move down here. This red is going to have to get down in here. And when it gets down in here, it might feel more uncomfortable. but it is what's going to happen. But it'll be okay, because as we break through the trough, we will then begin to move into early upswing, because that's what we're looking for. And part of what we're all trying to do, you included, us included, we're trying to figure out what we do here through this rotation at the bottom as we move up, because there's opportunity. There's always opportunities. That's why I showed you all those sectors that rotate through as we move through the cyclical nature of the economy. It's not just one thing works or not. There's choices, opportunities. There'll be challenges, unexpected consequences of it, but there'll be unexpected opportunities as well. So that's part of what we do with this also. So last week, I went into more detail with this. Some of you loved it, some of you hated it. It's fine. I was trying to show you the peaks and the troughs. I was trying to show you the support and resistance levels, trying to help you understand the process for how we think through each item. Just to kind of give you a start for what we'll be doing here as we go forward over the next few weeks. But really the big piece to walk away from this is just what it says down here. While history doesn't repeat itself, it often rhymes. Well, these are two very different times. September 2000 to 03 and October 2007 to March 2009. But the charts don't look all that different. I mean, they are different, no doubt, but they don't look all that different. That's because there's a rhyme there, and there'll be a rhyme here. This one will look different. It may not look as bad as these, because these were both terrible dips. These were both really bad downturns. Hopefully, we're not going to see that. Hopefully, what the U.S. Department of Treasury is doing, what the Federal Reserve is doing, what the administration is doing, what the governors will do, what business will do, what you and I will do, hopefully that will change this model. So with these downturns and these peaks and troughs, we're trying to figure out what our options are. So let's take a look at a little bit of that, a little more detail here to kind of explain something. And I said it last week, but the truth is, it's a very interesting concept. So when we're looking at this, and just for the record, I'm not a pilot. So consequently, if I'm looking at gauges on a massive dashboard for an airplane, I don't know what those gauges are saying. So you could tell me and I wouldn't understand. If you're a pilot, you'll know that I wouldn't. If you're a physician, you understand things. You're talking to a patient, and you're like, that's not right. That's what this is. This is my version of that. This is what we look at to see something. And I said to you that we have these moving averages. This is daily activity up and down. It's just going to do it. It's very jagged, hard to read. So we use averages where we take periods of time, 20 days, or we take 50 days, or we take 200 days, and we do an average and just roll it forward one day at a time, which gives us indications where the daily activity breaks through, or then the shorter, like the 20-day will break through the 200-day, and the 50 will break through the 200-day. And then they'll do the reverse, too, on the upside. That's what I was showing last week. So when I'm looking at this, I'm looking for something very interesting. And one of the things I said to you when I showed you the chart last week, and actually the week before, I said to you, as this activity runs up, it's going to hit the 50-day moving average. And when it hits the 50-day moving average, it's going to do a concept. It's words, convergence, divergence. It's going to converge into it and diverge up or diverge down. That's what's going to happen. And I told you I think it's going to converge down. I didn't know. I just had an opinion. My opinion was it would do this. And look, here's what it's doing. It's converging down. It ran up into the 50 because you have to understand the stock market is a market force, and that market force has two groups, buyers and sellers, and they're at war every day. Not in a bad way, but the buyers say there's more of us, we're going to push it up. The sellers say there's more of us, we're going to push it down. So what happens is this 50-day moving average is one of those weird little things where it causes either the sellers to go, there's more of us, we're doing this. Or it causes the buyers to go, there's more of us, we're going to break up. So what you'll see, and I'll do this here, that little section right there, it's like watching water boil, but the truth is, it's very important to pick up on. It tells us what's happening, what may happen next, because you'll notice here it's now running down into the 20-day moving average. So I'm curious what that's going to do next. I do expect that it's going to turn around, head back down. I don't know that it's going to go test the lows of March 23rd, but I wouldn't be surprised if it did, but it might not. It's just going to depend. I told you about the ceilings of resistance. What happens is the buyers buy so far, and then the seller's like, I can get my money back now because I should have done it last time. And then the buyers take over again, and it keeps happening. But at the same time, there's a floor of resistance. where the sellers drive it down and the buyers say, this is crazy, I'm buying in now. And they buy in. Now you'll notice if you look at these two lines, they are getting closer. And they do that all the time. They just start to get to a place. And when they get so tight, sooner or later the activity breaks above or breaks below. It's just one of the things we watch. Now when it happens, it tells us, along with fundamental information, other information, what we should be looking for to make better decisions, back to industry rotation and sector rotation and so on. These are things that we look for to try to make sense of what's going on. Again, trying to push out all the noise and all the drama and figure out what's real and what's not. Now this is the Dow Jones. This is the S&P 500, and you'll see it's had a similar behavior to the Dow. It's looking kind of similar, and it's got similar behaviors on the resistance and the support. This is the Nasdaq. Now the Nasdaq, you'll notice it's done something different. It broke above the 50-day moving average and then came back down. Now it's resting on top of it, and we're going to see what's going to happen in the next few days. You'll also notice it broke above the 200-day moving average, which is really a big deal. Now, you might be like, well, why? Well, it's really pretty simple. The Nasdaq is very technology heavy. Remember what I showed you on the industries and how technology was doing so well compared to the other groups? Because we're home now. We're watching Netflix. We're buying on Amazon. We're playing video games. We're doing all kinds of stuff like that, and technology is essential for it. So that's what's happening right now. Now, if this turns around, breaks down below well, you can see it's right here at the 200, broke below back again today. If it holds that and continues on down, that's another piece of information. So it's not just one piece of information. It's almost like if I gave you a page with like 6 paragraphs on it, if I only showed you 4 or 5 words and I said to you, what's the page about? You're not going to know. I wouldn't know either. But when you put all the words together, you add more and more words to the page, you begin to figure out what it's about. And that's why we do this. This is the volatility index. This is actually futures contracts traded on the Chicago Board of Exchange. And what it does, it's like supercharged trying to figure out what's going on. The higher this goes, the more everybody's worried things are going to tank. When it's down here, and if we were to compare the two graphs to the S&P 500, it was low when the S&P 500 was high, and the same with the Dow, and the same with the Nasdaq. They're up here when it's down here because nobody's afraid. And then COVID starts to become more understood. And so we move into February. People are like, is this bad? Oh, it's not so bad. But wait a second, it's terrible. And here we are, March 23rd, and oh my goodness, it's terrible. Then it comes back down because maybe there's a rally happening. Then it runs down below, in this case, the 50-day moving average, and it runs back up, and now it's testing it. Again, I'll be showing you these charts next week. We'll see where it's at then, because all of this comes back together to say to us, what do we do right now? Is it time to get back in? For many of you, you've moved back to much more conservative positions. That's great. That's exactly what we're doing, because I've shown you the charts about, minimize the loss. It makes it easier to make up the gain. So that's what we did. Well, we don't want to sit out when it's going back up again, so we're watching for the information to make a decision. It's time to go ahead and get back in again. See, these charts are going this direction, which going down is a good thing here, not a bad thing, as compared to the other charts going. These are reverse of the previous 3 charts. Hopefully now, as you're watching this, you're starting to get a little better understanding of how we're making decisions. And it's helping you to figure out how you want to make decisions. And I started off by really sort of emphasizing, again, setting the SMART goals. Part of setting the SMART goals is to know what your risk tolerance is. And I'm very pleased to say that more of you have done your risk scoring, and I'm glad for that. I want you to do it, because if we understand what your real risk tolerance is, you won't be surprised and we won't be surprised. I hate being surprised. I like to be able to know what to tell you to make the best decisions. And if your score says you are 90, meaning you're very risky, we don't want to have you conservative when you can handle risk. On the other hand, if you're a 23, we don't want to have you at 73 because you're going to be upset, you're going to lose sleep, you're going to get mad at us. And so one of the things we've been encouraging everybody to do is to do the risk scoring. Many of you from the last meeting did, and we've got phone calls coming up with you. Some of you still haven't. My encouragement is just email Lorena and say, hey, I want to get the link so I can do my risk scoring. Because as you can tell, we're not just sitting here idly waiting for I don't know, President Trump to tell us it's okay to invest. We're actually trying to look ahead. When I share with you that the 4 phases will be 12 to 18 to 24 months out, but the market will be 3 to 6 months ahead of that, that's why we're looking at all the things we're looking at. Plus a lot of things I haven't had a chance to share with you yet. Some of it I'll share, some of it I won't. It just won't matter. Some of you, though, if you really want to know, I'll be happy to. Which brings me to another thought we have. Well, let me do the quick review, and then I'll share the other thought. So what we've covered is economic perspective. We've covered SMART goals, and hopefully you're thinking more and more and more about what your goals are, because that helps you to make better decisions. When you know the direction you want to head, the destination you want to get to, your direction gets easier to figure out. We'll talk about that more in upcoming meetings as well. We talked about COVID-19 and what's been happening, the 4 phases back to normal, along with the 3-phase Getting America Back working plan. We talked about market recovery types, fundamental and technical considerations we're watching. I'm sharing with you throughout this some of the things that I'm looking for and that you should look for in the coming weeks. The risk-reward discussion. A couple of reminders. 1, 3 years from now, I believe that CV-19 is just going to be a memory. We'll have a flu, cold, and COVID or coronavirus season. We'll have vaccines. I still think beyond that, it'll be a memory. Again, in the last number of years since 1928, which really, if you think about, it's almost 100 years now. That's crazy. We've had 25 bear markets, 26 bull markets. Probably going to be at 26 bull markets and 26 bear markets now. Average bear market was less than 300 days. Average bull market was more than 3 years. Average loss during the bear market was 36%. Average gain after the bear market, or when the bull market started to the peak, was 112%. 23% of the time, less than a quarter of the time, were we in a bear market, but more than 3/4 of the time we're in a bull market. So this is temporary. I don't have any reason yet, and even though I see things, I watch things, I'm like you, looking for potential problems. I'm not trying to say that this couldn't be bad. There could be terrible things that come out of this. We're watching for those too. But at this point, I think that it's going to be okay. It's going to be good. It's going to take some time here, and there'll be opportunities to take advantage of. So until then, we just all have to be wise and safe and well and smart. So this workshop, this webinar, is really designed for you who've worked with us for a while. We've had some guests come on, I know that. We've had some people who've been with us for a while who've never really had these conversations, I know that too. But the fact is, we've also got the ability to do a beginner one, something for somebody, and that doesn't mean that they're beginners themselves. They may have been investing for a while, but they don't know anything about us. And so if you would like to invite your friends who are not clients to any of these updates, please email Lorena for a special webinar available for your guests. We're trying to put together a small one here, hopefully in the next 2 weeks, so that they can attend, because I know that you're getting information. I've had several of you tell me that you're talking to friends who aren't getting this information. And so if you'd like to have some of your friends do this, it's a chance for them to do this. As you can tell, there's no risk or anything. We're just sharing information that if they can use it, great. So if you have anybody, email Lorena, and that's at lorena@franksoffice.com, and she'll help get everything set up for you. And also I would throw in that if you want to talk, maybe you don't want to ask a question in this group setting, but you'd like to talk, again, feel free. We'll be happy to schedule time either to talk on the phone with you, to do a webinar. We're not doing in-office appointments right now, just for a lot of reasons, but I'm hoping that that's going to change here within the next few weeks. Florida is supposed to hit its apex by May, and if we start relaxing some of those restrictions, I'm looking forward to doing that again. So, and I'm going to go ahead and bring the webinar to a close. As I said a moment ago, I love talking to you. I love helping you, and whatever you need, we're here for you. So just be well, be safe, and be smart, and I will look forward to talking to you at the next webinar. So thank you, and have a great evening.